So screen sharing, brilliant. Thank you so much for waiting for me, guys. I really appreciate this. All right, so look, a very warm welcome. It's awesome to see some regulars here this evening. So look, from me and the FP Markets team, thanks so much for taking the time out of your evening to be with us. As usual, look, any technical issues during the presentation on your side, please let me know, and the support team will try and get you sorted. By way of a quick introduction, my name's Aaron Hill, and I am part of the research team at FP Markets, and I've been involved in the financial markets for more than a decade now, for nearly 13 years. So as the title of this presentation implies, I'm not here to attempt to show you how to trade, or put better how I trade. I'm going to attempt to try and show you ways of thinking while you trade. Now, just to be clear, I'm not a psychologist. I'm certainly not here to say one approach is better than the other, or this is the way that I'm going to show you. I'm sure there are other ways of approaching the market regarding your mindset. So I'm sure we can all remember the first time we were introduced to the financial markets. The first book I read was actually titled Trend Trading by Darryl Guppy. And from the point I closed that book, I was hooked. I was obsessed, and unfortunately believed trading was an easy way to make money. My expectations were skewed, you could say. This is the first biggest mistake I made, and one I see a lot of new traders make as well. We essentially think that trading cannot be that difficult. It's even worse when we have a handful of winning trades. That really reinforces this notion that trading is easy. Now, the disclaimer, look, trade responsibly. Derivative products are highly leveraged, carry a high level of risk, and are not suitable for all investors. Features of our products, including fees and charges, are outlined in the relevant legal documents available on our website. Now, I'm going to begin with a term we're all familiar with, fear. So we all know what it means. We all experience fear. And fear, I truly believe, is one of the primary factors behind failure to achieve consistency. And according to many, controlling fear while trading is actually a learned skill. Why so many lose in trading has always really been interesting to me when we have access to some of the best data. We have volatility measures, we have implied volatility, we have historical volatility, we have the ATR, the average true range. We also have, sorry guys, we also have Bollinger Bands, which are also volatility indicators. And we also have advanced risk management software, as well as an unending list of technical indicators, both discretionary and non-discretionary. And we even have software applications that, as you can see here, highlight a double top pattern, a double bottom pattern, AB equals CDs, triple tops, triple bottoms. But look, the point is still, with all of this technology at our fingertips, the majority of us still struggle to generate consistent returns. Now, I'm in contact with a number of truly remarkable traders, and I asked them what makes them different to the consistently losing traders. Now, as you can imagine, risk management was a key response. A good edge, a good strategy that provides you an edge was another. But do you know what the common response was? It was how they think. It was their trading mindset. They just think differently to other traders. Now, there are three types of traders. There are the consistent winners, there are the consistent losers, and there are what's known as boom and busters. Now, the tendency for boom and busters are to make money, to lose money, to make money, lose money, until the accounts or we as traders give in and we can no longer trade. So whenever I think of boom and busters, I always picture a roller coaster. We're at the high 1 minute, we're at the low the next, the high the subsequent month, if you will, and the low at the the next month. Those who have attained a level of consistency and, shall we say, fall into the bucket of consistent winners, among other things, have learned to control fear, or learn to understand fear, I should say. This, as I said, is a learned trading skill and is part of your trading mindset, one that the late Mark Douglas talked about, and is one that's really backed by trading psychologists. Now, I'm sure we can all relate to this poor chap here at one point or another in our trading careers. This is what fear looks like to me. I'm not sure what that's supposed to be. Is that a mobile phone or a mouse? I'm not sure, but yeah, nevertheless, this is what fear looks like to me. Fear is so powerful, it can make us hesitant to trade. It can drive us to make poor decisions. Fear can override our ability to think rationally, to think objectively. And ladies and gentlemen, to trade successfully, we need to be able to think rationally and objectively. Now, on a physical level, it appears we enter into a fight or flight mode when we're in a trade. Why this occurs is very difficult for me to understand. All I can put it down to is when we enter into a trade, our brain is interpreting this as a threatening situation. So the possibility of a losing trade is interpreted as a threatening situation. Now let me be clear. Can fear be removed? Now I've seen a number of YouTubers saying remove fear. It's impossible to remove fear. We are human. We all have fear. So can fear be removed from the trading equation? It certainly cannot. But we can learn to control our response to emotions felt while trading. Now, it does not matter if you have a superior trading strategy. If you cannot handle the fear of trading with real money, it will not help. So how can we learn to control fear when trading? Now, as far as I'm aware, there are no easy ways to do this, to reduce fear, to reduce the fear of trading. And this is why I believe so many of us, so many successful traders can take so long to reach a level of consistency. Now, the only way that I've found that makes sense is a method known as systematic desensitization. I know it's a mouthful. I believe this is also called exposure therapy. And the target is to decrease your anxiety or your fear in a very gentle and gradual manner. So look, if you're if you're fearful of spiders, the way to fix this fear or lessen its effects is through it can obviously be done. So what you do is to lessen the effects, you have to be around spiders more often. That's easier said than done. I do know that. But this can obviously be done slowly, and through time, your fear should begin to lessen. Now, this is the only way I know and the only way I've used. So it's repetitive exposure to what you fear. Right. So look, a technique I will leave you with is to become accustomed to fear, the risk of trading or the fear of trading slowly. A lot of us jump into live trading accounts with account balances far beyond our tolerance, if you will. So by gradually becoming accustomed to the fear of trading, I found that fear actually gradually diminished. You see, I never removed fear. The emotion of fear still exists within me, but the influence of fear has certainly lessened. Now, quite simply, I was instructed by some good friends of mine, some good traders, to begin with a demo account, as I'm sure most of us were here. I also used the FX tester as well to increase my increase the time I spent back testing strategies. Now, the key point is what this provided me, what these back tests provided me with were statistics, and these statistics elevated my confidence, or give me a license, if you will, to move to trade live. From there, from there personally, I started with an account of 500 UK pounds and risked 1%, which is £5. You see what I was doing here? I did not rush in. I took things slowly and knew I had to familiarize myself with the risk that I am trading. Now, if you do this, fear should gradually begin to lessen. Now, if I was able to grow my account, so if I was able to grow my account over the next quarter, then I would feel comfortable increasing the account size. How much should you increase your account by? Well, of course, that would be down to the individual trader. We're all different, of course. For me, it was the next step was 1,000 UK pounds and risking £10. So following this, the next step was £3,000 and risking £30 of risk. Now, just to reiterate, this is the best way. I personally have found that this is the best way to not only increase confidence, but also help reduce the fear of trading. Finally, also try to keep the long-term goal in mind, which is longevity and a healthy respect for risk. Now, I'm sure this you're all familiar with this handsome chap, Warren Buffett. Look, as an extension to the previous slide, I'm going to touch on something I believe is similar to, as you can see here, to one of Warren Buffett's famous quotes, and really relates to how I look at fear when in a trading situation. So be fearful when others are greedy, and greedy when others are fearful. I've purposely kept the next slide as basic as possible. So let's imagine we were looking to enter long from this rather long-term resistance turn support area. Not that it matters, but this is a euro-dollar daily chart, which extends to September of 2021. So hence why I said a long-term resistance turn support area. So let's imagine we have our pending entry order set at this point here, and our sell stop below here, our protective sell stop order set below here in the event of an unfavorable trade. Now, if price had begun to turn against us once our order had been filled, so price was, let me just see if I can get the pen. I'm a bit hesitant to use any of the functions given my given what's happened at the beginning of the session. So look, imagine price began turning against us after the after the pending entry order had been filled. So what's happening is price is beginning to push into our support area, and at this point it's threatening. We've all been here. It's at this point here. It's threatening to tag our sell stop, our protective stop loss order. Now, at this point here, I've found that many will actually become hopeful that price will return back to break even. But what I've trained myself to do is become fearful at these points here, become fearful at this point here, this area here. And so fearful rather than hopeful at this point here. So we at this point are hopeful that the trade will turn around and become either break even or profitable. I understand this, and this is, yeah, it's very normal. But there is another reason we are hopeful at this point, and that is crucially to avoid or circumvent pain. So our brains are hardwired to avoid and escape pain. It's there to help us survive, right? Signaling an imminent threat that we need to evade. And through our losing trade, through our trade entering negative territory, we are experiencing emotional pain. The possibility of not only losing money if price hits our stop loss, but also we're open to the possibility of course being wrong. So our brain at this point looks for ways to evade, to escape, and put an end to this discomfort at this point here, which can result in us moving our stops. So if we move our stops, say we look to this demand area here. That's a terrible way to draw that. Let me just draw that in. So we see this demand area here. It should have been drawn a little bit better. Bear with me. This point here. Okay, this point here. So it may see us move our stop just below this area here. And what that does is increase our risk exposure. And at this point, once we're moving our stop, what we're doing is hoping that price will obviously turn around before it hits our new stop loss to put an end to this painful experience. So well, look, what our brains are clearly looking to do is to avoid this uncomfortable situation. Now, and this is the same as when we take profits early. So imagine price is now up here and we're thinking, okay, now is a good time to get out of this trade because we've already been into negative territory. And I don't really fancy entering that zone again, if you will. So we cut our profits. We liquidate our winning position earlier than what our strategy, our rules of engagement inform us to do. And you know, when you close that winning trade early, you feel at ease, and importantly, the pain of potentially giving up the unrealized profits have ceased. So you've evaded pain yet again. You could give any reason you like for doing this. The best one is you cannot go broke taking a profit. You certainly can go broke taking a profit in this industry. So look, with the losing trade, there is actually nothing to hope for at this point. My fear is price will actually gap beyond my stop, and you'll understand why shortly. So my fear is price will not hit my stop loss, because I placed my stop loss when I was in complete alignment with my trading strategies, rules of engagement. I was also, very importantly, I was also unemotional. I was also I was unemotional at that point because the trade had yet to have been filled. So why would I want to change this stop when or if the trade goes against me? The answer is fear, and the answer is very clear. It's fear and evading pain. So the point I really want to end this slide with is to try and think clearly when you're in a trade and understand that you have completed the hard work before. You've applied your technical analysis, you've applied your fundamental analysis, you have a bias, and you've done the hard work. You've set your entry, you've set your stop, you've figured out where you've located your take profit levels, and you're good to go. So, and importantly, you were not emotional at that time. So also, you might want to consider switching from being hopeful to fearful in a losing trade, and from fearful to hopeful in a winning position, and really see how this works out for you. Look, when I knew it was time for me to alter my thinking. Now, I was fortunate enough to meet my mentor at a relatively early stage in my trading journey. I wish I could tell you that I attained a form of consistency in my trading within a year, 2 years, or even 3 years of trading. It certainly was not the case. It certainly was not the case for me. I chose to ignore some aspects of my mentor's advice and take a painfully frustrating route, as I chose to believe I knew better. So I chose to ignore the importance of a trading journal. I chose to ignore suggested reading material. I also chose to ignore my mentor's warnings regarding trading psychology and how important it was. So we generally come into trading with skewed expectations. I'm willing to bet 99.9% of us, look, I'm willing to bet all of us here came into trading with skewed expectations. I certainly did. We neglect the fact that we could potentially lose money, or we sideline the fact that we could potentially lose money, and our focus is directed to how much money we can make and the impact on our lifestyle. I will say this: the path to consistency can be very frustrating and stressful if you overlook the emotional component of trading. So is it worth it? As you can see here, is it worth it? What I mean by this is, I mean, is all the stress and frustration worth it? Are all those years of study worth it to trade consistently? For me, it certainly was. Some consistent traders actually disagreed, as it led them to a life of loneliness. Now, I understand this as you are essentially trading from a home office with no one but the market to talk to, and this is why I believe you see so many trading academies emerging. And although some of those lack credibility, if you will, there are some with well-seasoned and experienced traders behind that academy, and they are certainly the ones you want to learn from. Right, so the defining trade that really made me sit up was one I remember vividly. I was long the pound dollar, and it was a Friday. It was the day of the US non-farm payrolls event. Now, this was years ago, where volatility was increased volatility was seen during the non-farm payrolls. It's calmed down in recent years, in my opinion. Look, do bear in mind, though, at this point, my trade, my long pound dollar, I was trading a relatively large account at that point, and despite my shortcomings, I was actually making money, and I was confident. You would say too confident, I guess. To cut a long story short, I failed to follow my plan. And I decided that instead of liquidating my position ahead of the event, I decided to move my stop further away from my entry, consequently increasing my risk exposure. Now, my rationale for moving my stop was simple. I was right, and I just needed to give the market some room to breathe. Now, the NFP was released and was positive dollar. Now, remember, I was long pound dollar. So I was long the British pound, and I was short the US dollar. So the event was positive dollar, and price began to decline. I would say began. Price did not just hit my stop, it actually gapped below my stop. So I was actually left with a larger loss than I planned, on top of moving my stop. So look, really what I want to try and get across to you, to everyone here, really is, following this huge loss in the space of seconds, I knew I had to change. I knew I had to take a step back. I knew, no matter how much I wanted to jump back in the market and then to I wanted to short the pound dollar, because that's the direction it was headed. And the reason why, I wanted to reclaim my losses. Now, thankfully, I did not succumb to what's known as revenge trading. It's an awfully vicious cycle and can end accounts. Now, this was a trade that the pound dollar long trade was one that really affected me financially and damaged me psychologically. But it was the trigger. It was the catalyst, if you will. I clearly needed to change. So I had been well and truly humbled by the market that day. For me, it was around 8 years before I attained any form of consistency that I was satisfied with. And to achieve that, it required me stepping back from the larger account size that I spoke about earlier, and slowly following the advice of building my account with a risk, so I did not make these foolish mistakes. Now, what I mean by building my account slowly with the risk is on the slide here. So following this process here. So what I did was follow this process here. I found consistency on a demo account. I went through a small account size. I started very small, as I said, the £500 account, risked 1%, and incrementally increased the account size. As I showed that I can consistently trade. What this did was it enabled me to control fear and gain the confidence to understand, to work with the risk levels. Now, this is something I did not have in my pound-dollar long trade. I was not comfortable with the risk, but I was very comfortable with my analytical skills. Both of them need to be in line with each other if you want to be a successful trader. Now, and this really leads on to the next slide here. Now, I've met a lot of brilliant traders, and all of them have reaffirmed this point that no one knows what will happen on a trade-by-trade basis. Now, this is a crucial point many traders merely only pay lip service to, and do not truly accept that they have absolutely no control over the next trade's outcome. Can anyone tell me here if they've ever? I know for a fact all of us have observed this, felt this, experienced this in a trade. You believe you have control over the next trade. You're at the screen, almost encouraging the market to move in your direction. It does not matter. You have absolutely no control. The quicker you learn that, the quicker you'll become a more free trader, if you will. So it does not matter whether your system has a winning percentage of, say, 70% or even 80%. It's impossible, even with those high winning percentages, it's impossible to know whether or not the next trade will be a winner or loser. But this is the crucial point. On average, over a sample of trades, say 10 trades or 20 trades, we can expect 70% of those trades to be winners, because that's our edge. But, and this is the key point, it's impossible to know which trades will be the winners. So anyone who's read the late Mark Douglas's work will know exactly what I'm talking about here, as this is who I learned this from. So if that's the case, why would we panic if the trade turns against us? If we understand we have no control over the next trade, and we've set our risk, we've set our entry, we've set our take profit objectives, why would we panic if the trade turns against us? We have to accept. No one knows what will happen on a trade-by-trade basis. So why would we move our stops? To avoid pain, meaning we have truly not accepted that the next trade can either be a winner or a loser. I know it's difficult. I know this is difficult to achieve. But once you achieve this, once you truly accept that you have no control over whether the next trade will be a winner or a loser, the easier your trading will become. And so, look, feel free to correct me if I'm wrong, but the way I see it, as independent traders, we can control 4 things: entry and exit, our risk management, our mindset, which is what this presentation is all about, and of course, the trading plan. Now, everyone here should understand these 4 points. Our entry and exit is part of our trading strategy. Our risk management is part of the overall trading plan. Our mindset is something you need to continually work on and study. And your trading, well, I've just said your trading plan, which houses the trading strategy, the risk management, your goals, everything. It's your blueprint to trade. Now, and alongside alongside accepting that and understanding that we have no control over the next trade, we also have to understand and accept that while we are in a trade, it is not about being right or wrong. This should be evident by now. It's okay to be wrong in trading. In fact, I can guarantee you will be wrong, and you will be wrong a lot in your trading careers. And the sooner we accept this, as I've said, the easier your trading will become. So a good trader once told me, and it really stayed with me, to grow as a trader and develop a trading mindset, we must become a master of accepting that we will lose money, and we will lose money on trades, and we will be wrong. Think about this logically. This goes against everything I was, and I'm sure you was, ever taught in school and as a child. I had to be right to pass my exams. Really, even from a young age, who here has become accustomed to losing money? I'm willing to bet most of us never really have. Now, ego. I really wish I had an off button for ego. We all have an ego, and it can be incredibly detrimental in trading. Often it's our ego that gets us to overvalue our own ideas, what the market should do. And it's normal. Look, your ego wants to justify your successes, right? Yet it does not want to admit or face losses. And look, I think this quote really sums it up nicely. There is nothing that strengthens the ego more than being right. Being right is identification with a mental position, a perspective, an opinion, a judgment, a story. Eckhart Tolle. Now, I think it really sums up our ego very, very well. All right, so how can I alter how I view the win-loss theme? So I know you've probably started, but stop reading this part here, okay? I'll come to that in a minute. I should have really hit that, but I haven't. So look, most dislike losing money. And if we top this off with being wrong in a trade, it's easy to see how we can turn traders into revenge traders. Now, I alluded to this term at the beginning, I think, revenge trading. And what it is it's a natural and it's an emotional response when a trader suffers a significant loss or a number of consecutive losses. Now, before taking the time to think about their next move or looking at their trading strategy, what they do is they enter another trade after their big loss to attempt to recoup their losses. This can be a result of a number of things, a result of anger at the loss, generally disappointed that you made the big loss. So they want to, as I said, recoup their initial losses. I understand this. I have been there in the earlier stage of my trading. I certainly did this, and I'm sure most of us here have experienced this emotion as well. Some people also want to. Some people revenge trade with the goal of avoiding shame. This is mostly, I think, it's mostly common when you're trading as part of a team. And this impulsive response, this revenge trading can in turn lead to excessive over trading. Another mistake many traders make and cause themselves a lot of heartache with their accounts and a lot of unnecessary losses. So I've mentioned a number of times that we need to accept that we cannot possibly know the next trade's outcome, and that we must accept that trading is not a right or wrong business. I'm sure you've heard of this so many times, but it's so very crucial that you carve this into your mindset. We cannot know the next trade's outcome, and we have and trading is not a right or wrong business. So how can we start to accept this? How can we start to accept that trading is not a right or wrong business? We cannot know and begin to accept that we have no control over the next trade. Look, Very simply, we can start by conducting a backtest. I cannot tell you how comforting it was to actually have these statistics by my side. This will provide the stats required to give you the confidence to continue after 1, 2, 3, or even 4 consecutive losses. I know we've all been there. 2, 3, 4, 5 consecutive losses. It's heartbreaking, I know. And I promise you, this will happen to you if it hasn't already. You will experience consecutive losses. So this is where I read this part. We already know we cannot put any emphasis on one individual trade. So if we know that, and we know that as long as risk is controlled, then why are we concerned with winning and losing if we know through our backtest that we have an edge? Now, you are very welcome to use it to have these slides. Just send me an email. I'll give you the email. I'll provide the email at the end of this session if it will help you. So do let me know via email or through the chat box, guys. So let's think about it like this. We spent the time backtesting and likely forward testing on a demo and a small live account to validate our trading strategy. And we have these stats to back this up. And let's say that in our backtest, our max drawdown consisted of 8 consecutive losses. All right, that's in our backtest, our max drawdown, 8 consecutive losses. Then why would we panic after 2 or 3 consecutive losses, as this information is not new information to us? You see, if you put the work in with backtesting and you begin to understand that trading is a very psychological profession or a psychological career, if you will, it will make trading with live money a far simpler and a less stressful endeavor. Okay, so what is a trader's mindset? A trader's mindset for me is someone who is dedicated, disciplined, has no trading ego, and has controlled his or her fear of losing money. Like learning to trade with fear is a learned skill, acquiring that overall trader's mindset is a learned skill. Now, I have met a handful of traders that have this trader's mindset, and it's quite amazing to see. It really is quite refreshing to see how you can transform your mind and become the trader that you want to be. And by following the steps I've provided you with, you will gradually become that trader that you desire to be. Ultimately, though, unfortunately, though, there is no blue pill that I can give you today that can magically transform you into a trader. Like everything, guys, hard work, determination, and willpower is needed in this to reach a level that you desire. So first and most importantly, I should say, learning how to work with fear is crucial to attain a trader's mindset. Look into the technique, systematic desensitization. All right, look into this. Try and work with this with your trading. Start small, work slowly. Trading is not a race. You're not competing with anyone but yourself. It's you against you. Start small and backtest. Crucial points, guys. Start small and backtest. Again, don't just pay lip service to this. Start small. If you're trading with a large account right now and you haven't acquired what's known as a trader's mindset, you may eventually end up becoming in a very difficult position like I once was. Working with a backtested trading strategy provides you, as I've said, with the statistics to maintain a strong, healthy mindset when losses occur. And again, guys, they will occur. I do see your question, Anonymous. Can you please send the slides? I will do, no worries. I'll provide you with the email. If you could just send me an email requesting the slides, or I'll try and get one of the support team to note down your email. But please, I think it would be easier if you just email the team following this presentation, then I'll know who to send it to. Look, what do I mean by statistics? So you have your win percentage, which is your winning trades, divided by the entire body of your trades. You have the losing percentage, which is the same thing. You're focusing on the losing trades. You have gross profit, the result of all your profitable trades, the net profit, the difference between your gross profit and gross loss. Profit factor. This is a profit measure that takes the a ratio between your gross profit and gross loss. Now, ideally, we always want this to be above 1. So, for instance, if your gross profit is, if your gross profit is, say, $10,000 for the year, and your gross loss is 5K, that should be 5. That's not a 3. Let me just color that in. 5K. So 10 divided by 5 is 2. So what this tells you is that for every so basically you've earned double twice as much as you've lost, if that makes sense. So that's you should always aim for more than 1, because you don't really want to you don't really want to have a gross profit and gross loss at the same, because if you've earned the same and you've lost the same, you've earned nothing. So you really want to have at least 2 or above for your gross profit. Now, if you're interested in profit and risk measures, I have conducted a webinar on this. You can find that under in the archives on the FP Markets website, and that will under resources, I believe, and you'll find that there. We also have things like max drawdown, maximum loss from an equity peak, maximum consecutive losses. So you want to know all of these stats: maximum consecutive wins and losses, expected payoff. So that's calculated as the net profit divided by the total positions. So, for example, if you make 100 trades in a month for a total net profit of $1,800, and we divide the total net profit, which is 1,800 divided by 100, gives you 18. So $18 is your expected payoff per trade. Sharpe ratio is another good one. That's a performance measure widely used by industry professionals. That's risk-adjusted return. You'll also know you also want to know your average reward to risk, and you really want that to be around 2. Some will know this as your payoff ratio, the average winning trade divided by your average losing trade. Again, if you have an average winning trade of 400, and you divide that by an average winning trade of 200, you do the maths, guys. So what that gives you is a way of, so that is 2, right? So we have 2. That tells you that on average, your winning trades are more than your losing trades on average. So look, I'm going to pretend. I'm not going to pretend that learning to think like a professional trader is easy. It's certainly not. I'm not going to say that professionals do not doubt themselves, as they do, but I will say that trading successfully is possible if you are willing to change the way you think and approach trading. Now, I'm going to wrap up this presentation and offer some trading quotes from some truly great traders. So the goal of a successful trader is to make the best trades. Money is secondary. Alexander Elder. Trading is not about being right or wrong. It's a probability game. Mark Douglas. A typical trader wants to be right on every trade. Again, Mark Douglas, a key gentleman in the trading psychology world. He's wrote 2 books, I think. But the key one for me was Trading in the Zone, if you're interested, guys. In this business, if you're good, you're right 6 times out of 10. You're never going to be right 9 times out of 10. I think what he means is you're never going to be right 9 times out of 10 on a consistent basis. Questions, Q&A, guys, Q&A. We only have one question here, and that's for the email. So if there's no questions, I will wrap this up. While I'm wrapping up, guys, please do throw over any questions. Look, the next webinar for this month is trading using the Dow theory on the 25th. As always, if there are any specific topics you would like the team here to talk about, please be sure to send in your suggestions to either support@fpmarkets.com or marketanalyst@fpmarkets.com. Now, if you require these slides or you're interested in learning, talking about this more, please do email me at marketanalyst@fpmarkets.com and the research team will reply. Also, do make sure to sign up to our FP Markets Telegram channel. We now have a newsroom as well. This is something that we're trying to work on, and we're constantly active within that room in regards to news and possible setups and things like that. So do sign up. You should have a link in the chat box. There we go, FP Markets Room. So do go ahead and subscribe to that. And and I'll see you there. Look, okay, on that note, if there's for the anonymous attendee who provided me with the email, if you go ahead and email me with marketanalyst@fpmarkets.com, I'll reply to you as soon as I possibly can with all the slides. It's a PDF file. Okay, on that note, thank you all so much for taking the time out of your evening to attend this presentation. Look, guys, I'm really sorry for the terrible start with the technology. It won't happen again. I hope it won't. So look, but overall, I really hope you took something away from this presentation and it benefits you. Thank you, and I'll see you all again on the 25th of this month. Thank you very much, guys. Thank you. Good night.